Hello everyone, my name is Moji. You're watching a Bitcoin bubble news channel. We've seen cars stop moving. They have kind of leveled off but stopped growing at poor or below average rates. Less money is being spent on major projects. Consumer confidence is going down again. Housing was beginning to get better, but now it's back to where it was, at least when it comes to sales. Okay, so there has been a rolling decline. It looks like we're now in the all-at-once phase. As I'm sure you've seen, the stock market is correcting quite a bit after the drop we saw last week. Bond rates are going down pretty quickly. Prices for many goods are going down and some are even breaking down. Yield spread, which means the difference in interest rates between high-yield bonds and government bills, treasury bonds, it's beginning to gape out that spread. In other words, fear is showing up in the markets in a lot of different ways. In this video, Cathie Wood, an American investor who is the founder, CEO, and CIO of ARK Invest, talks about the possibility that a recession is coming soon. Interest rates have been lowered to between 1% and 0.25% in the world's major countries. In the US, rate cuts could happen at the next OMC meeting in September, even though the Fed kept rates the same at the last meeting. As market prices fall after adjustments in the commodity and bond markets, even though fears are growing because inflation is still high. Since 2022, the Fed has been raising interest rates all the time to try to control inflation. This has made inflation worse. Cathie Wood talks about what this means for the market and how it affects digital investments, especially Bitcoin. Please like the video, subscribe to the channel, and turn on post alerts so you can see more videos like this as we bring them to you. Add your ideas, comments, and observations to the conversation by writing them in the box below. Everything you do is good for the YouTube system and helps the channel grow a lot. Thanks, and have fun with the movie. We do have a point of view, which is why I'd like to share it. The phrase slowly then all at once has been used before, but in case you haven't heard it, I'll say it again. As we've been talking about the rolling recession that has been going on since the Fed began raising rates in 2012, as soon as the Federal Reserve started to raise interest rates, there was a real drop in the value of homes. Commercial real estate and office space were already in a bubble, and now mixed housing seems to be a problem. We've seen cars stop moving. They've kind of leveled off but stopped growing at poor or below average rates. Less money is being spent on major projects. Consumer confidence is going down again. Housing was beginning to get better, but now it's back to where it was, at least when it comes to sales. It's been a rolling decline, and now it looks like it's happening all at once. We think that a lot of people are starting to see that the idea that inflation is the problem might not be the right one. And prices will be the end of this rolling slump. I've been saying that the risk is deflation, which means prices going down. After hearing Amazon's report last night, it's clear that customers want lower prices and are getting them. People aren't going crazy yet. In fact, they're reacting to some of the lower prices, even in cars. But prices are still going down, which is bad for businesses. In other words, their profits will slim down. That's why the all at once has to do with signs of decline. The Purchasing Managers Index PMI came out this week, and the jobs report came out today. These are both signs of a slowdown. There are more and more people who think we're in a slump. In fact, the sum rule was set off by the jobless report, which showed that the unemployment rate had gone up by 50 basis points compared to its low point over the previous 3 months. This has made a lot more people think about a slump. We don't mean anything when we say all at once anything like 2008 to 2009. As a matter of fact, the rolling recession part of this situation would make that less likely. That is not at all what we're saying. What we are saying is that this focus on price power is going to be important. And this is why it's important inflation was also in the double digits in the early 1980s, when Fed Chairman Volcker was trying to kill inflation with interest rates in the double digits. That was a lot of room for him to make a mistake if he did make one. The rate of inflation here is a lot lower now. In fact, the Fed has less room for mistake now. I also think that keeping prices higher for longer and thinking that inflation was the biggest risk has put us in some danger. But knowing what the problem is only half of the answer. So I believe this moment of getting rid of stress is good. These changes are painful and only last a short time because they cause a lot of stress. It turns out that the world doesn't work the way a lot of people thought it would. And one idea that you'll hear more and more about in the news is that the success of the Japanese yen against the dollar is another thing that affects market changes, especially in the foreign exchange FX market. Japan just raised its interest rate from 0% to 0.25% to stop the yen from falling against the dollar. Japan still has one of the lowest interest rates in the world, which is something to keep in mind. Because of this rise, a lot of assets have been sold, and people who borrowed money now have to pay interest on loans that were put in dollar-denominated assets. Let's hear more about this from Cathie Wood. When people talk about the carry trade, they mean that a lot of buyers and traders borrowed yen. In other words, they were short yen. Because Japanese interest rates were so low compared to the rest of the world, they borrowed yen. By borrowing money there, they then put those assets to work in other currencies or dollar-based assets, but mostly dollar-based assets like our government bonds, which were yielding more. Now, the yen has been either going down or staying the same since 2011. You weren't taking that much of a risk when you bet to short the yen or borrow the yen. And if the value of the yen went down, you gained because you were making more money in the US. Some people believe that part of the carry trade is borrowing yen and then buying the Mag 6 or one of the US broad-based measures like the SP 500 or the NASDAQ 100. Both are very full and heavy with the Mag 6, so while we don't know for sure how much of this happened, these are our best guesses. A report from Deutsche Bank said it might be $20 trillion. Take a look at that. The size of our GDP is about $25 trillion. Can you picture this carry trade, which was now a $20 trillion deal that everyone agreed on? That might be true, but I'm not sure. To put it another way, I think the value of the world's stock markets is about $130 trillion right now. When put next to $130 trillion, $20 trillion is also a very big trade in the market. The exact number is unknown. It does make sense when you see how quickly the yen is rising in value now that the carry trade is ending. People who thought the yen would keep falling in value are now changing their minds. They have decided to give up, or they're being called on their profit and have to sell. Since the real crisis in 2008 and 2009, we've been marketing maybe in 2011 and 2010 in the worlds of private equity and private credit. When interest rates were very low, people looked for ways to make money. We think that private equity and credit moving into the multifamily area has been a very big trade. Rents were good returns, which helped them get more money. That's another source of debt we're keeping an eye on. That being said, private equity and private credit often bundle this debt together. A lot of people say, oh my goodness, could this be a replay of 2008 to 2009? We don't believe that. Back then, subprime mortgages were put together into AAA bonds. That really shouldn't have taken place. But the reason was the cost of homes. It had never gone down across the country. Some pockets would go down, but the whole country has never gone down. That did change in 2008 and 2009. I don't think that's happening again. It has more to do with business and real estate. If we look back to 1986, when I think tax rules changed and real estate lost its tax shelter status, it was mostly commercial real estate that was hurt. The rest of the economy, on the other hand, was not affected. Let me explain what I mean when I say slowly, and then all at once some trades will be unwound here, but we don't think anything systemic will happen. It is possible for prices to go down, which is what we think.